So return scenarios are a feature that have been around for quite some time in RightCapital, but with all of the new modules and new features that have been added over the last couple of years, I can definitely understand how they might sometimes get overlooked. But that being said, return scenarios can be a really powerful tool in your toolkit as an advisor, in that they allow you to stress test a client's plan in the context of different market scenarios and to get ahead of some of those client questions about whether or not they can still achieve their financial goals if the markets take a turn. So we're going to be shining a spotlight on return scenarios in particular today, including how to build your own custom return scenarios and then apply those in various places within your client plans. On the agenda for today, we're going to start with a quick refresher on return scenarios in RightCapital. So we're going to take a look at what they are, where you can find them, and we're also going to review the default scenarios that are pre-built into every RightCapital account. We're then going to take a look at creating custom return scenarios. So I'll show you how you can manually build those out in the advisor portal, and we'll build out a few custom scenarios together and go over some best practices there. We're then going to take those scenarios and start actually applying those to a client plan. So we'll talk through some of the use cases and I'll show you the different modules where those can be implemented. And as we're doing that, we're going to take a look at some of the key comparison visuals in each of those modules so that we can see the impact of our return scenarios on our projections. So that being said, lots of content for us to cover here today. I do want to quickly mention that if you have any questions as we're making our way through the presentation, please don't hesitate to ask those using the questions field in the GoToWebinar control panel. I've got about 40 to 45 minutes of prepared content for you today. And then for the last 15 minutes or so, I'll be taking a look at your questions and answering as many of those as I can until the top of the hour. Perfect. I'm just going to switch over to my RightCapital login here. So bear with me just a moment and then we can get started. Perfect. So here we have our case study for today. We're going to be looking at a single plan today for Jane Shepard. And I'm just going to quickly take us through the blueprint module in the profile section, just to get us all acquainted with this client and generally what's going on within their plan. So clicking into the profile blueprint area here and taking a quick look at their net worth, we can see that in terms of overall net worth, this client is sitting at around $1.1 million. We can see that there's only one individual in this plan, so all of the assets are listed here under Jane. Jane is currently 56. And then in terms of the goals timeline, Jane's current target for retirement is currently age 65. So in addition to that, we also have a couple of other goals occurring here in retirement. We've got a recurring car goal here for some new car purchases once every 10 years or so. We have a vacation goal here in the couple of years after retirement. So Jane is planning to put around $5,000 a year aside to do some traveling in those years. And then we have the typical retirement healthcare costs and long-term care costs reflected here as well. And taking a quick look at the income, savings, and expenses, Jane is a relatively high earner who currently has a salary of $120,000 a year, in addition to a self-employment income stream of around $40,000, so two income streams there. Jane is currently maxing out her traditional 401k contributions as well as Roth IRA contributions. And in terms of expenses, Jane's currently spending around $5,000 a month in pre-retirement. And I believe I have that same figure in here for post-retirement monthly expenses as well, that $5,000 a month figure. Perfect. So now that we're a little bit more familiar with this client plan, let's talk return scenarios. The place that these are most frequently utilized is the comparisons tab in the retirement analysis section. So let's get there and take a quick look. I'm going to click into the retirement analysis area here, and then again into the comparisons tab. So for those of you who might be unfamiliar, return scenarios are RightCapital's way of allowing you to view a client's plan and future-looking projections in an entirely different context, using a very specific sequence of return. And the default scenario that we're always going to be looking at to start things off in a financial plan is this baseline scenario here. So as a reminder, there are always two different projections happening in RightCapital at any given time. We have, of course, the Monte Carlo projections in our probability and confidence tabs. And what we have here, the Monte Carlo inherently has volatility factored in. We're looking at a wide range of potential outcomes with random fluctuations and volatility, factored into each trial here. But at the same time, we also have our baseline projection, which is what we see in most other areas of the software, including the retirement cash flows. So, with the baseline, this is a straight line linear growth projection that's going to use your advisor-specific return assumptions as the long-term rates of return for each asset class. So the baseline is the default return scenario in RightCapital, but if we click this drop-down menu here in the upper right, you'll notice that there are some other scenarios to choose from here besides just our baseline. So these are the pre-built return scenarios that are built into each and every RightCapital account. And this is where we can start to inject some volatility into this analysis and leverage some of these comparison charts here. So I am going to toggle through each of these quickly just so that we can take a look. We have our bad decade followed by slow growth scenario here, so a little rocky here. We have the Fed adverse scenario followed by modest growth. We have the strong growth scenario in addition to a flat 0% return scenario here. So now that we've quickly toggled through each of those return scenarios, let's take some time to review each of these pre-builts in a little bit more detail, and then we can talk about building out custom return scenarios as well. So for the next part of this presentation, I am going to be exiting this client plan and clicking back into the advisor portal here. And then I'm going to navigate to the models tab at the top of the page, and then the scenarios area of the models tab here. So this is going to be your home base both for reviewing the pre-built scenarios and taking a look under the hood of those, as well as building out your own custom return scenarios. So first things first, we are going to be reviewing each of these existing scenarios here, starting with the bad decade followed by slow growth. Before I dive into the specifics of this scenario, I'm just going to take a quick second to sort of explain what we're looking at here on this page. On the left-hand side, of course, we have the scenario that we're currently viewing. And then on the right-hand side, we have the specific sequence of return that scenario is using. So we have our respective return percentages for equities, fixed income, and cash for each and every year of our scenarios here. So these scenarios extend out 50 years. So from year 1 to year 50. More specific to this bad decade followed by slow growth scenario, what we have here are 10 years of fluctuating returns that are generally not looking so good. And if this looks a little bit familiar to you, that's because this scenario is a very close reflection of the market between the year 2000 and 2009. So that is what we have here. We can see year 9 here being, of course, 2008 with that large dip in equity. So, a little bit more specifically, the equity column here, our team used the S&P as a reference for these, specific values year to year. For the fixed income column, our team referenced the Bloomberg Aggregate Bond Index, or the AG, as some folks call it. So we've got returns here that are based on that very specific time frame for our first 10 years. And then in year 11, we sort of level off here for the remainder of our scenario. And this is the slow growth portion of this scenario. So we have a long-term projection of 2% for equities, 1% for fixed income, and 0.25% for cash. Our next scenario here is somewhat similar. We have the Fed adverse scenario followed by modest growth. So there are some similarities here. This one does also level off at a certain point, but in terms of the actual sequence of return here, this is a 4-year hypothetical recession, essentially, based on the type of stress tests that the Federal Reserve releases each year to specifically test the solvency of large banks and financial institutions. So we have this immediate, very large dip in equity for year 1, and then a further decline in year 2, followed by a recovery in years 3 and 4 here. And then once again, we level off for the remainder of our scenario here, this time with a modest growth projection. So we've got 4% for equities, 2% for fixed income, and 0.5% for cash. Our next scenario here is the strong growth scenario. Unlike the previous 2 scenarios that we just took a look at, this one's not based on anything quite so specific. This one is just a more general strong growth hypothetical scenario created by the RightCapital team. So what we see here are some fluctuating returns for our first 10 years that are generally pretty strong. And then, once again, just like the others, we do level off eventually here in year 11 with strong growth projection. So we've got 8% for equity, 4% for fixed income, and 1% for cash. And then, last but not least, we of course have our flat 0% return scenario, which, simply eliminates returns across the board here for the entirety of the projections. So if you ever need to look at a plan with no growth factored in for any reason, this scenario rather is here for you. Great. Now that we've looked over the pre-built scenarios here, let's spend the next few minutes building out a couple of different custom return scenarios. So to create a new scenario here, all we need to do is click the Add Scenario button here in the upper left. Something I want to point out whenever you add a new scenario here is that it will actually copy whatever scenario you're currently viewing as the sort of template for that new scenario. So, I was just viewing the flat 0% scenario there when I clicked the Add Scenario button. So I started off with a blank slate here, but just as an example, if I was viewing the bad decade here and then I click Add Scenario, it's going to have those values translate over to my new scenario here. So that can be useful if you do want to create a new scenario that is similar to one of the existing scenarios. However, if you do want to just zero out all these values, you can either copy the flat 0% return scenario, or if you've already copied another scenario like this, you can always click the Quick Fill button in the lower left and simply clear all of those values to zero everything out. Perfect. So I'm going to start here by just building out another flat percent return scenario, just something quick and easy to simply demonstrate how this process works. So first, I'm going to name our scenario here by clicking this pencil and paper icon. We'll call this, we'll do a flat 6% return scenario here. I'll click the check mark to save. And then for our values here, I'm going to enter 6% across the board for year 1. That way, regardless of how an individual client is actually invested, it will always see exactly 6% returns using this scenario. So at this point, if you've ever created a custom return scenario in the past, you may recall that previously we would have had to enter 6% into every box here for the entire duration of our scenario, which can definitely be a little bit time consuming. But that being said, within the last few months, we have actually added a really nice quality of life feature here, which is the Quick Fill Interpolate feature here in the lower left. So instead of having to copy and paste 6% 150 times in this scenario, we can now enter 6% for year 1 at the top of our scenario, enter 6% for year 50 at the very bottom of our scenario. And then if I click the Quick Fill Interpolate button here, it's going to fill in the gaps for the entire scenario here. So that's a really quick and handy feature that we recently added. And our 6% scenario here is finished. This is our flat 6% return scenario. Do not forget to hit the save button, as I almost did here. You will want to make sure to lock in those changes. If you do click away without pressing save first, it might revert some of those values back to what they were. Let's create one more scenario like this, but instead of a flat 6% across the board, let's do something maybe a little bit more realistic. So I'm going to create another blank slate for us here. And then maybe we'll do 7% for equities, 4% for fixed income, and then 3% for cash. This is a relatively close reflection of the JP Morgan forward-looking assumptions. This is why I chose those values there. So once again, I'm going to enter my values for year 1. I'm going to scroll down to year 50 and enter the same values here. Then I'm going to quick fill interpolate to fill in those gaps for this scenario. Once again, I'll want to remember to name this scenario. So we could call this something like JP Morgan. If you want to be extra clear about what's happening in this scenario, just to make your life easier in the client plan when you're selecting these scenarios, you can always do something like this where you enter the returns for each category in the actual title of the scenario. And that way, when you're toggling between those in the client plan, it's very explicit what's happening in that scenario. Perfect. All right, let's create some more complex scenarios here. So one of the most common types of scenarios that we find our advisors are building out here are market crash scenarios. That is definitely a major concern for a lot of clients. And these return scenarios can be a great opportunity for you to stress test a client's plan in that way and to visually demonstrate for them what that might look like within the plan. So we of course have the bad decade scenario here, but by building out our own custom scenarios, we have some additional flexibility. Maybe instead of a market drop in year 9 or 10, like in that bad decade scenario, maybe we want to see an immediate market drop or a market drop in year 2 or 3. That way we can compare and contrast within a plan and see the impact of market crashes at different times during a client's life. So let's build out a scenario or two like that. Let's start by building an immediate market crash scenario. So this time I am going to use similar returns to the historical assumptions in RightCapital. So I'm going to plug in 10% for equities, 4%, 4.5% rather for fixed income, and then 1.5% for cash. If I haven't mentioned it yet, as a pro tip, you can add up to 2 decimal places here. So if you want to be a little bit more specific with the returns in that year, you can always add that second decimal place. I'm just going to sort of set my canvas here by adding all these long-term assumptions for the entirety of the scenario here. So I'm going to do the year 1 and year 50 and then interpolate to fill in those gaps. So now we have our nice long-term assumptions entered here. I'm going to click save. And then the next thing we want to do here is add that market drop. So we're going to add that in year 1. So I'm going to plug in some similar numbers to what we saw in that bad decade scenario for 2008. I'll do -34 for equities. I'll do 5% for fixed income. And I'll do 0.2% for cash. I do want to quickly just reference the bad decade scenario so I can take a look at the year after that dip just to have a more realistic recovery phase here. So it's like 22, 6, and I can do 0.2 again for cash. 22, 0.2% for cash. Once again, I'm going to click save. So we're good to go there. And then the last thing that I want to do for this scenario, I want to show off one of the other neat things that we can do with our interpolate feature. So maybe we don't want this scenario to level off quite so quickly in year 3 like this. Maybe we want this to level off more gradually over the course of a few years here, and maybe by year 5, let's say. We can use our interpolate feature to accomplish that. So the first thing I'm going to do here is I'm going to replace years 3 and 4 with zeros. And then if I use quick fill interpolate here, the system is going to use linear interpolation to fill those gaps and gradually take us from value 1 to value 2. So we can see that for our equities that started off at 22%, these are slowly declining by 4% each year until we level off at year 5. And then for fixed income, we're declining by 0.5% from 6 down to 4.5. And for cash, we're actually increasing incrementally from 0.2 up to 1.5. So the quick fill feature isn't just useful for those flat return scenarios, it's also very useful for creating a more gradual incline or decline in values like this. Perfect. Once again, I'm going to remember to click that save button there. And then I am also going to name this scenario quickly. So we'll call this market crash. See if I can spell today. Market crash year 1 and save. Perfect. And the very last thing that I'm going to do here, and the last scenario that I'm going to build out for today, is a market crash in year 10 scenario. That way we'll have a couple of different references within our plan to test for sequence of return risk. As I'm sure we all know, the timing of those market drops can have a huge impact on a client's portfolio, even if the long-term rate of return is exactly the same in both of those scenarios. So I'm just going to build this scenario out quickly. I'm going to do the same thing I did before and sort of set my long-term assumptions here. I believe I did 1.5 for cash, 10, 4.5, 1.5. Then I'll quick fill interpolate to fill in those gaps. And then instead of year 1, I'm going to add that market crash and recovery in year 10. So I'm going to enter the same values here for year 10. For year 11, I believe we did 22, 6, and 0.2 again. As you may have noticed, I've gotten into the habit of clicking that save button every time I make a change here. If you find it easier, you can also click enter on your keyboard rather than physically clicking the save button with your mouse, just to make sure that your changes are being saved every time you change one of these values here. And then the last thing I'm going to do here is just interpolate those values. So what we have here now for years 10 through 15 is the exact same market crash sequence that we see in our year 1 scenario, except instead it's happening in year 10 here. So let me just double check these numbers to make sure I entered everything correctly here. Perfect. I am going to remember to name this scenario so that we can tell the difference within our plan. I'll do market crash year 10 here. Perfect. So those are all the scenarios that I'm going to be building out here for today. I'm really just scratching the surface here in terms of what you can do with these, but in addition to these flat return and market drop scenarios, you can also build out scenarios with more extended periods of low returns or a crash with a slower recovery than the ones that we've modeled here. You can also build out scenarios that demonstrate for a client how much of an impact sequence of return can have on their portfolio. So you can build out 2 scenarios with identical long-term rates of return, but one that has an equity dip now and a rise later, and another that has an equity rise now and a dip later. You can use these to reflect extended periods of actual historical returns based on market research. And I've even seen advisors take a 10 or 12-year stretch of historical returns and then sort of loop that over the duration of the scenario here, just to have something with similar long-term returns as the baseline, but with more variance in terms of the year-to-year returns. So there's truly so much that you can do with these, and I hope that the exercise of creating these together has helped to spark some ideas of scenarios that you might want to build out here and utilize with your clients. Speaking of, that is a fantastic segue into the next part of the presentation today, which is utilizing these with our client. So now that we have these built out and saved here in the Models tab, I'm going to click back into our client plan for Jane, and we can take another look at that Comparisons tab in the Retirement Analysis section. So I'm going to open up Jane's plan here. I'm going to click back into the Retirement Analysis Comparisons tab. And now that we're back here, we can see that in addition to those pre-built scenarios that we were looking at here before, we now have all of our custom scenarios available as well. So let's take a look at each of these in the context of this plan here for Jane. These first 2 scenarios are likely going to look very similar, but we have our flat 6% return scenario. So in terms of ending assets. This one is sitting at a $2.9 million figure as opposed to our baseline, which is 7.7. So pretty significant difference there. We have our 743 scenario, which is a little more similar to those JP Morgan returns. Just for context, I am using the historical returns in RightCapital for this baseline assumption here. So this is significantly more conservative with these JP Morgan returns. And then we have our market crash in year one scenario. So we can see that dip from 55 to 56, and then followed by that recovery, and then we level off here with those long-term assumptions. So this one's ending with 6.5 million in assets. And then we have our market crash in year 10 scenario here, which coincidentally in this plan happens to line up with when Jane is expecting to retire at age 65. So, I would expect this to have a more significant impact in terms of ending assets. We see that this one is sitting at a 5.8 figure here for the end of the plan compared to that year one crash sitting at a 6.5. So, in a case like this, even though these scenarios aren't exactly breaking the bank, we definitely see the impact of these scenarios on the client's invested assets at the end of their life. And just to, show the baseline scenario here, I did intentionally craft those two market crash scenarios to have similar returns in the years outside of that 5% or that 5-year crash and recovery phase. So, even with a long-term rate of return that is very similar to our baseline, we have a difference of 1 to 2 million in ending assets, depending on our return sequencing and the timing of those market drops. And at this point, if the client is maybe a little bit concerned about one of these scenarios actually happening, this is the point where we can start to show the client, what we can potentially do to the plan, for that scenario using our action items here at the bottom of the retirement section. So, we can say to our client that if everything goes according to plan, you can retire at 65. You can spend $5,000 a month in retirement and in pre-retirement, and you can set aside that $5,000 a year after retirement to do some traveling. But if we take a look at something like this bad decade scenario, if this scenario were to happen in reality, and you want to make sure that the client has enough money for long-term care costs near the end of the plan here, we might just need to make some slight adjustments in that case. So maybe instead of retiring at 65, we can show Jane retiring at full retirement age, maybe spending slightly less in general. I'm going to reduce the monthly expenses for pre and post retirement here, and then maybe picking some less expensive vacation destinations in the couple of years after retirement here. And then if I click refresh, hopefully we'll see that take us to the end of our plan without running out of money, which we can see here in our proposed section. So you can really see how these scenarios can go a long way and how you can utilize these action items here to plan for those specific scenarios and anticipate those client questions and concerns. Perfect. The next thing that I'm going to do here, and the last thing that I'm going to do for the presentation today, is I'm going to show us all the different places in RightCapital that you can apply return scenarios. So there are a couple of different areas in addition to the comparisons tab here where these can be applied. Before I switch away from the comparisons tab, I do want to quickly mention that while reviewing a scenario like this, you do have the flexibility to take a look at these other charts in the comparisons tab. So in addition to just the invested asset portfolio, we can also look at the client's overall net worth, which of course is going to have real estate value factored in here. We can take a look at the client's taxes paid over the course of both of those projections, as well as the assets at retirement in our current versus proposed. So you have some additional information here in the comparisons tab that you can view in the context of these different return scenarios. We can also use return scenarios in the retirement details tab here in the analysis section. So in addition to comparing our current and proposed, we can also take a look at some more specific information in retirement for our proposed plan in particular. So maybe we are looking at this bad decade scenario and we want to see the income sources over the course of that scenario. We want to see specifically maybe the savings withdrawals year to year, if that bad decade were to happen. And we can isolate that information here in the retirement details area. This is also where you can find the year-to-year withdrawal rates. So if you were looking to do some, isolating some withdrawal rates over the course of one of these scenarios, you can find all of that information here in the retirement details. So lots of great information available for us from comparisons and retirement details combined. This next one is a little bit more situational, but if you have a client who has a stock plan, if they have equity compensation, let me quickly just turn on my stock plan that I have on the back burner here so we can take a look at this. If you have a client with equity compensation in the form of something like restricted stock units in this case, you can utilize those return scenarios in the analysis tab of the stock plans module. So you'll find all those scenarios here. So this can be very useful if you are finding yourself putting together a stock plan proposal for a client. Maybe they aren't quite sure what to do with some of their options and you're trying to put together a comparison for them in terms of what they're doing now versus what you would recommend they do in terms of exercising and liquidating their options. You can view these proposals in the context of any of your custom return scenarios. So this is one of the other areas that we can find the return scenarios in RightCapital. And then last, but certainly not least, we can also take a look at our custom return scenarios in the cash flows section of the retirement tab. So with this in particular, you won't find them here by default, but there is a setting that you can enable within your client plans if that's something you'd like to be able to see. So just to show us that quickly, I'm going to open the settings in a different tab here. And specifically what we're looking for is the gear icon, settings, methodology tab. And then if you scroll down to the bottom of this page, it is this first checkbox on the right-hand side. So allow display of scenario-specific cash flows. So if I check off this box and then click Save, back in the cash flows here, if I refresh this page, we'll see that we have an additional menu here to select a specific return scenario and view the year-to-year cash flows for that scenario. So, if you are utilizing these return scenarios, if you have maybe a historical return loop that you're using and you want to see the client's year-to-year cash flows in the context of those, that very specific sequence of return, you can use this option to take a look at the scenario in the cash flows. So, of course, in addition to the summary here, which shows us the yearly inflows and outflows, maybe the invested asset tab is a better representation in this case. We can take a look at the year-to-year portfolio return in the context of some of these scenarios. So, isolating year 9 here, we see that large dip. This is our 2008 essentially in this scenario. So, this is a really useful tool if you are using one of those return scenarios as a way to inject a little bit of volatility into this analysis, and you want to be able to really crunch those numbers and see the specifics. You're able to enable those within the cash flows here. If that's something that you find useful and something that you maybe want to turn on globally so that you don't have to click into the settings of each client plan and individually enable this checkbox, I'm going to just show us quickly where you can set that as a client preset back in your advisor portal, just so that for all of your new clients going forward, you can make sure that that box is checked here. So I'm going to go to the advisor portal here, and I'm going to click into the gear icon client settings area. And then the client presets tab here is what we're looking for. So again, that's gear icon, client settings, client presets. So this is where we're able to set those preset settings that are going to be used for all of your new clients going forward. So if you do want those scenario specific cash flows turned on in general, you are able to check this box here and click save at the bottom of this page to make sure that that's on by default. So the one nuance with this page is that it won't change that setting for any of your existing clients. Making changes here is only going to apply to new clients that you create going forward from that point on. So you may still have to individually toggle this setting on for some of your existing client plans, But this will ensure that you have that option to view those custom return scenarios within the cash flows for all of your clients going forward. Perfect. So I'm just going to do a quick recap of all of the locations that we can find those return scenarios. So that's going to be the retirement analysis comparisons tab, the retirement analysis retirement details tab, the retirement cash flows if you've enabled that specific setting, and then also the more menu stock plans analysis tab. So those are all the locations where we can enable return scenarios.